we have a sell-off. We had a tremendous rally since they enacted QE in March. March through April, bond yields went to zero, and now we're back again. So I think that is partly due to, beyond the economics, partly due to the way they carry out QE. They tell us only ex-post what their activity has been. For instance, just yesterday we learned that the duration of the German portfolio that they hold has dropped by about a year, which means that at the margin they bought shorter maturity bonds, and that has amplified, I think, the sell-off at the long end of the curve.
They also told us they were going to front-load, but then I look at the data and it's not much of a front-loading at all, is it? It's an extra €3 billion. So it's very hard to gauge not only the quantity of what they're buying, but then, as you've been discussing, the price discovery. The big discussion coming into this was price formation. How long do they leave it in the primary market, into the secondary market, to allow for price formation? Is that disrupting the bond market in any way at all?
Well, I think, there's a confluence of factors. The bond market is not elastic as it used to be, and that is because all the regulations and balance sheet constraints. So that is a structural element here. Then you have Greece, which obviously is a big perturbation, as we talked about. Then you have treasuries that are a bit opportunistic in their issuance. They announce longer-dated issuance as these lofty prices are still in place, and that creates events for dealers. And on top of this, then you have the ECB that doesn't tell you ex ante what they're going to do. And a client of ours calls it a freestyle approach to QE, which I thought is cute. And that just creates volatility of its own. But look, I think at the source of this sell-off is the fact that yields were at ridiculous levels. We talked about it the last time I was here. And we've had a revision of inflation, which ties into the euro, which ties into the oil price developments, etc.
The last time you and I spoke, of course, we were approaching 0% on a German 10-year. We're above 0.7%. Only 2 days ago, we're below 0.5. You sit here, I bring up your forecast onto the screen, and we're forecasting German yields to maybe have another extra 20 basis points of upside, as far as you're concerned.
Yeah.
That could happen in a day. How do you make those forecasts, Francesco? Is that job getting more difficult?
I remember last time you joked with me, you said bond yields are going to double. Well, from zero, that's easier to
that's
achieve.
A couple of basis points.
Right. I think, look, we have now 90 basis points, which, is a guess, I would say.
Yeah.
Because it's going to be the wrong price in any event. I mean, why 90 and not 125 or 70? My observation is this. If the ECB wins on inflation, and we're starting to see some of the effects of QE and higher commodity prices, for instance, the five-year forward that Draghi mentioned months ago is now 1.7% and has been creeping higher since February. So we would expect that to go back to 2% and drive the whole nominal curve up with it, so a steepening of the European curve. I think, on our calculations, the effect of QE is about 60 basis points on the fair value of bonds.
Right.
So they're going to stay below 2% for a good period of time. But, again, if they win on inflation, we should see higher yields.
Bringing